Welcome to Economic Growth Path, where we analyze complex financial realities and challenge the emotional narratives often surrounding extreme wealth creation. It is incredibly easy to feel anger toward billionaires today, viewing them as greedy entities, hoarding resources while others struggle daily. However, most public outrage is fueled by a fundamental misunderstanding of how capital, assets, and economic systems actually function in reality. We must look beneath the surface to understand that wealth is not just money in the bank, but a complex mechanism. In this video, we will dismantle 6 common myths regarding assets, taxes, labor exploitation, profit motives, leverage, and true social impact. By the end of this journey, you will shift from emotional reaction to logical curiosity, understanding how wealth is truly built. The first major misconception is the belief that billionaires sit on piles of liquid cash, swimming in gold like cartoon characters. In reality, net worth is almost entirely composed of illiquid assets like company stocks, factories, intellectual property, and operational infrastructure. Jeff Bezos does not have billions in his checking account. His wealth is the estimated value of Amazon's warehouses and logistics. You cannot simply withdraw $1 billion from an ATM because that money is tied up in buildings, equipment, and payroll. This wealth is theoretical and volatile. If the company fails tomorrow, that massive net worth evaporates into thin air instantly. Think of their wealth not as a stagnant pool of resources, but as a flowing river of capital fueling economic activity. Many billionaires are actually cash poor relative to their assets, reinvesting everything back into their companies to drive further growth and innovation. To access cash, they must sell shares, which means giving up ownership and control over the very systems they built. Therefore, hating someone for a high net worth is often hating them for owning a successful system that society values highly. This leads us directly to the second point of contention: the argument that billionaires do not pay their fair share of taxes. The tax system is designed to tax realized income, not the fluctuating value of assets that have not yet been sold. If your home increases in value, you do not pay taxes on that gain until you actually sell the property. Taxing unrealized gains would force founders to liquidate their companies prematurely, destabilizing the economy and destroying the businesses they created. Furthermore, if we taxed unrealized gains, would the government also issue refunds when the stock market crashes and values plummet? When billionaires do sell their stock to buy yachts or mansions, they pay massive capital gains taxes on those specific transactions. They also pay significant consumption taxes whenever they spend their money, contributing to public funds through their lavish lifestyle choices. The system is not necessarily broken, it simply operates on the logic of realized cash flow rather than theoretical paper valuations. Now let us address the most emotionally charged argument: that billionaires hoard wealth by exploiting the labor of the working class. This view relies on the labor theory of value, which incorrectly assumes that effort and hours worked are the only things determining worth. In the modern economy, value is subjective and scalable. A single piece of software can serve millions without requiring millions of workers. Billionaires often get rich by creating systems that deliver immense value to consumers, such as faster delivery or better information access. We voluntarily give them our money because they offer products or services that improve our lives more than the cash we hold. Employment is a voluntary contract where workers agree to trade their time for a wage they deem acceptable at that moment. The founder bears the catastrophic risk of failure and bankruptcy, a burden that salaried employees are generally shielded from carrying. Profit is not theft. It is the small margin remaining after all costs, wages, and risks have been successfully managed. This brings us to the fourth point: understanding profit not as greed, but as a critical feedback mechanism from the market. Profit is the signal that a business is using resources efficiently to create something people actually want and are willing to buy. Losses are equally important, signaling that resources are being wasted and should be reallocated to more productive uses elsewhere. Billionaires are effectively the custodians of capital, who have proven their ability to allocate resources more efficiently than their competitors. Fifth, we must understand the concept of leverage. Hard work is linear, but leverage allows for exponential results and wealth creation. You cannot become a billionaire just by working harder. You need code, media, capital, or labor working for you while you sleep. J.K. Rowling wrote Harry Potter once, but media leverage allowed that single effort to be replicated and sold millions of times. Tech founders use code leverage. Their software has zero marginal cost of replication, allowing them to scale to billions of users. A billionaire's high income reflects the magnitude of their decisions. One right judgment call can generate billions in value for society. Sixth, we often judge their morality solely by charitable donations, ignoring the massive social impact of their core business operations. The greatest contribution a billionaire makes is creating sustainable jobs that allow thousands of families to support themselves with dignity. By lowering the cost of goods through efficiency, they effectively raise the standard of living for everyone, including the poor. Even when they do give to charity, the most effective billionaires apply business principles to solve problems, rather than just throwing cash. Building a profitable business that solves a problem is often more sustainable and beneficial to society than a one-time charitable donation. Finally, we must address the psychology of the observer. Envy is a destructive emotion that blinds us to valuable lessons. Instead of asking, "Why do they have so much?" ask, "How did they build a system that generated so much value?" Study their use of leverage, their tolerance for risk, and their ability to spot inefficiencies in the market to exploit. When you drop the narrative of victimhood and exploitation, you begin to see the economic machine clearly for the first time. We have covered assets versus cash, the reality of taxes, the creation of value, and the power of leverage. Wealth is rarely a zero-sum game. It is a byproduct of solving massive problems and scaling those solutions to the world. The goal is not necessarily to become a billionaire, but to understand the rules of the game so you can play better. The world rewards those who provide value. The scale of your wealth will always match the scale of the value you provide. Start thinking about how you can use leverage, how you can serve more people, and how you can own productive assets. Do not let political narratives or jealousy trap you in a mindset that prevents you from seeing the path to growth. Economics is a tool set. You can either complain about the tools or learn how to use them to build your future. We hope this analysis has provided a clearer, more logical perspective on the function of billionaires in our global economy. We know this is a controversial topic. We encourage you to share your thoughts and counter arguments respectfully in the comments below. If you found value in this breakdown, please subscribe to Economic Growth Path for more deep dives into financial reality. Remember, the rewards at the top are high because the fall from the tightrope of business execution is often fatal financially. Billionaires trade money to buy time. You can start by trading your time to build assets that will eventually buy freedom. They are not infallible gods. They are market participants who simply make more right bets than wrong ones over a lifetime. The future will be built by those who can organize capital and talent to solve the existential challenges facing humanity today. True economic justice is about ensuring equal opportunity for everyone to compete, not tearing down those who have successfully won. Wealth accumulation is the result of compounding. Compounding knowledge, compounding capital, and compounding relationships over decades of consistent effort. Do not hate the player who is winning. Instead, study the rules of the game and improve your own strategic moves. In the information age, your ideas and your ability to execute them are the most potent form of capital you possess. Behind every overnight success story is usually 10 years of invisible hard work, near failures, and persistent refusal to give up. Invest in your financial literacy. It is the only defense you have against the misinformation that keeps the majority poor. Join us on this path. Let us grow together, understand the system together, and build a more prosperous future for ourselves. Remember the 3 pillars. Net worth is not cash. Taxes are on realized gains, and wealth comes from creating value. And never forget, leverage scales effort, profit signals efficiency, and a curious mindset is your key to unlocking potential. Thank you for watching this in-depth analysis. We hope it has challenged your perspective and sparked new ideas for you. This has been Economic Growth Path. Stay curious, stay rational, and keep building your own path to growth. See you next time.